The broadcast is now starting. All attendees are in listen-only mode.
Good morning to everybody. Thanks for tuning in today. And I guess most of you are in a holiday mode right now, especially for the Chinese. Some of you might have you know, gone back to your hometown already. And I'm still in the KL. Not move, not traveling yet. But our speaker here is independent financial planner Lieu Fu. He is talking to us from his hometown at Sandakan, Sabah. So welcome, Liu.
Hi, welcome. Thank you. Hi, Casey. How are you this
Good,
morning?
good stuff. Yeah, pretty good weather now, But like it's Chinese New Year normally is very hot and dry.
Good thing lah. Else rainy, then it's kind of hard to do visiting and stuff like that.
Yes. So today you're going to talk to us about the investment policy statement, which is
Yes.
kind of new. I don't think other people talk about this, and yeah, let's get it started.
Hey, good morning, everyone. I guess I think how many live audience we have today? Let's see, slightly more than 10.
Yeah.
No problem. Everything will recorded, right? But no problem. So today it's at the time of this recording, it's almost Chinese New Year. I guess it's just right time to talk about investment now. At the time of this recording, as everyone knows, that we have kind of experienced a drop in the market for those who are invested in Malaysian equity. Yeah, at the end of 2014, I think everyone, one way or another, whether you are heavily invested in what we call as an oil and gas counter, right? Your portfolio will be more or less affected by the sharp drop in oil and gas counters over Q4 of 2014. So I think this is just a right time to talk about what we call as a portfolio optimization using an investment policy statement. So in the next 45 minutes, I'm going to from a very high level, I'm going to share with you what is an investment policy statement, what we call as IPS, how to actually, what are the elements of an IPS, right? So we are not really going into the technical details to how to construct your own IPS, no, it's just a concept, right? What is IPS? What are the components in the IPS? And how to use an IPS to optimize what we call as an investment portfolio risk-adjusted return. Okay, why I say risk-adjusted return is that we are not talking only about return itself, because in any investment there is risk. So whether the risk, one individual or a risk that you are taking is what we call as a commensurate with the return you're expecting to get or not. So for example, just a very short example, what we call as a risk-adjusted return is that if you talk about very simply a unit trust, and you say that, okay, this unit trust gives me, let's say, only a 3%, right? It's a 3% per annum return, and it's let's say it's an equity fund. Equity fund 3% per annum return, not very exciting, right? Not very interesting, not very high. But because probably the fund that the unit trust fund, equity fund that you pick is just a subpar, what we call as it's not a top performer lah. So it is historical, only give you 3% per annum return. Okay, and it's an equity fund, and everyone knows equity. It's high generally lah. I would say generally higher risk.
Yeah.
Compared to FD, right? FD, it also gives you a guaranteed 3%, but
Yeah.
the risk is almost zero. So if you have the same amount of money, where would you put? So rationally, you don't want to put into equity fund, which is subpar, only historically give you a 3% per annum return. You better put in the FD, right? So in that sense, although both FD and the equity fund give you just for the sake of example, in this case, a 3% per annum return. So the risk-adjusted return for the FD is higher than equity fund, because equity fund you have higher risk, right? And FD you have almost no risk. So that is what we meant by a risk-adjusted returns.
Okay, good. So
Right.
good explanation.
Right. So, but just on the very far stretch example, extreme example, lah, right? Extreme
Yeah.
example. And of course, the fourth thing we are going to talk about is how to use IPS as a tool to manage your expectation of investment return. Now, of course, if you do your own DIY investing, then you always hope for higher, you always expect more and more
Yeah.
the return, right? By stock picking or by value investing or by taking some of Casey's courses, okay? You feel like we want to always want to expect more, right?
Yes,
More return. But
definitely.
when when it comes to any advisor or anyone, even unit trust agent, anyone, when they actually recommend any instrument to clients, it is actually important to over what we call do not over promise, right? Kind of say, oh, this fund perform 30% per year. That one is probably that is a good year, right? So if you told clients only this point and you do not set the expectation right for clients, then next year if it doesn't get 30% return, then he's going to come back to you. Hey, you say 30% return, that's why I buy in. So it is always good to set a client expectation, right? Especially if you recommend some investment and stuff like that. And I'm saying this on a perspective from any unit trust agent or anyone that actually recommend any investment instrument, including myself, right?
Yeah.
As an independent advisor. So the exact definition of investment policy statement might be a bit wordy, but never mind. I try to simplify it, right? I try to simplify it. Uh, Investment policy statement (IPS) it is not a separate thing from financial planning. In fact, it is is an integral part of a financial plan. It's just that today I only want to talk about this section of comprehensive financial plan simply because when it comes to many aspects of financial planning, investment is probably I believe everyone is most interested in, right? Compared to other things like what estate planning
Yeah.
and
Insurance
risk management and
planning.
all
Yeah.
that. Investment, yeah. So that is why I just take this part and share with you this. So ideally, when we do financial planning for clients, they can, if they do a comprehensive financial plan, then this portion would be already in, right? But if a client say that, oh, I'm not ready for a full financial plan, but I'm interested in the financial investment portion. But before I want to invest in anything, I just want to know myself and know what are the instruments out there. If I invest in certain instrument, if I diversify such and such portions, what can I expect for the next 3 years? So an investment policy statement, when we do this for clients, this is exactly what we can show you and what we call as a set the expectation right lah, to say that okay, this is what you could expect based on, of course, historical data of what are the certain what we call asset class perform, let's say equity, bond, gold, and anything, right? How it perform over let's say a past 20 years period of time. So by that we can set your expectation right, and this IPS is actually what we call as it's something like a financial plan. It's a pure advisory services. It is in the form of a report, of course, and there are a few components in it which we are going to talk about. But to summarize, an IPS actually provides the framework for an investor, a framework for investor to invest, meaning that how they want to base their investment decisions on. Like for example, if this happens, what should I do? Right? If this happens, what should I do? If oil and gas, my portfolio, the other part of my portfolio drops 10% overnight, okay, what should I do? What's my option? So this document actually outlines the entire decision-making process. It is not coming from an advisor only, but it also takes into a client consensus with respect to the management of their invested money. Okay, so that even though what we call as the shit happens, right? Unexpected market fluctuations, maybe go up or go down. So a lot of people will say that, hey, how should I decide what to do next? So this document will actually outline what are the decision, not to say what are the decision, but what are the what we call as a decision-making process that an investor, as the owner of your money or invested money, should do based on what is happening. Okay, so it is a guide. Okay, you can say it's a guide lah for an investor to invest to put it very simply. All right. Okay. Of course, with a little bit of disclaimer over here, an IPS is prepared to assist in the analysis of an individual current financial position and help him or her identify steps that he or she can take to achieve a personal financial goal or objective. Although a great care has been taken to ensure the accuracy of this report, it should keep in mind that every what the data, the inputs take in is by the investor itself, and also based on historical performance of every asset class in a geographical location, let's say for the past 20 years. Okay, so by nature, okay, certain assumptions are made, right? Like in financial planning, you have to make certain assumptions like inflation 4%, right? Things like this.
Yeah.
So it is important, of course, as any financial plan, it's important to review this on a regular basis, yearly or so, to reflect your ever-changing and financial condition, and to make sure it stays relevant. So it's not a static document, but it is a live document. So now we go into a bit deep into the components of this IPS. So IPS, it's before we actually start, there are a few things that we as an advisor would like to understand. For example, the first thing is, what are your total assets? Okay, we do not need to know, okay, to construct an IPS. There's no need to actually know in detail what are the cash flow, but it's important to know what are the surplus or what are the deficits, and what are your current assets, whether it's properties, whether it's stocks, whether it's overseas property, private equity, everything, right? So there will be a portfolio of what we call as net worth. So this document also show what is your net worth, but most importantly, after tabulating all the information on your net worth, especially on the assets portion, we want to actually segregate what are the what we call as an asset allocation of your existing invested amount. Right now, for example, just to show you in a graphical example over here. So this is one snapshot from an IPS to say that this is one of the portfolio that consists a lot of cash, right? Cash meaning it could be cash in FD or cash management account and all that. So as you can see, there's almost 50% of cash. There's some fixed income, not much of global property, 20% of Malaysian equity. So this is a breakdown of, let's say, a snapshot of an investor portfolio. So what we call as a before, we always say about before and after, right? So they say that, okay, if you have a portfolio like this, of this asset allocation, right, based on historical return, you are expected to get about 6.71 per annum over a long period of years, let's say 10 years or 15 years or 20 years. So market will actually go up or down, right? It always go up or down, but we say that averagely, this is what you should expect, okay? If your portfolio is like this, or based on, let's say this is based on, from Malaysian perspective. And then your next question will be, why you say global property? Meaning that if you invested in some unit trust funds, they will be naturally, the funds are based are correlated with global properties or maybe some Asia Pacific funds and all that. So everything will be taken into account in this pie chart. So they say that long-term historical return 6.71, and what are the expected risks of this portfolio of this asset allocation is about 10.28%. So even risk we can measure one, yeah, 10.28.
What do you
Historical
mean
return
by
of
like 10.28% historical risk? Does it mean that they may lose like 10.28% in a year? Is that
Not
what it
exactly.
represents? Okay.
No, not exactly. It is more like a standard deviation kind of perspective. Not to say that if you actually goes up or down about 10 point something percent, but that is a very good question, because we do going further a few slides down, we'll actually address this question
Okay, good.
to show you what are the expected, right? How much it could go down. But just take this what we call as a long-term historical risk as something like a standard deviation. So no, not to say standard deviation, or I shouldn't have used this, but standard deviation, not to confuse the audience. It's just that it just like a number to measure how much risk is there in your
Portfolio.
in this portfolio, right?
Mm.
So this is what we call as a before, and what we call as a after, to say that again, different advisors will have their different recommendation to say that how you should what are the optimum way to allocate your asset class. Probably okay, this every advisor will have their own recommendation, our different perspective, right? And it also depends, like what we all know, your risk profile and what age you are in, what age range you are in. So for this example, a snapshot, before you have something like this, you get a huge amount of cash,
Yes.
about 48%. But once let's say we restructure this portfolio, maybe this cash you already allocate into some stocks, Malaysian equity, or maybe global equity, or certain funds, unit trust fund, it will actually change. Your asset allocation will actually change. And when your asset allocation change, your expected return and your risk level will also change. For example, I can say that this portfolio, the before portion, someone who are quite conservative and put a lot, in a very layman terms, a lot of cash or a lot of money still into fixed deposit. Now, when they take out that money and actually invest it well, then you can see that the allocation will be different. So it's quite well diversified into Malaysian equity, regional equity, and global equity, or even emerging market, and you are left with only about 10% in cash, right? So when your portfolio has been restructured in such a way, what is your what we call as a long-term historical return? So your long-term historical return would actually, the expected long-term historical return of such asset allocation would be about 8.5. So you actually what we call as we increase your expected return by around 2% over a long term, not per year, right? But this is per annum over a long term, right? And your risk also will increase that, because if you put into FD, of course, it's not much risk, but if you allocate into funds that will grow to global property or global equity, and that will increase your risk by 17.23%. Now, this is always what we call as an ideal recommendation, but without understanding, hello?
Yeah, I just mute myself for a while. My son is knocking on the door.
Oh, okay, no problem. Okay, I thought I got cut off. Okay. So what we are saying that here is that what we call as the portfolio allocation after what we call as a restructuring, right? But bear in mind, there is a constraint, right, that I put over here. What I mean by constraint is that there is always constraint in terms of how we could allocate a portfolio. The most what we call as the most common one would be, if you have a large portion of fixed deposit over here, it is unlikely you can actually allocate all of your fixed deposits into what we call as an investment into unit trust, because from a financial planning standpoint, you have to have probably at least 6 months of buffer, okay, buffer in your bank account, right, to cover for any emergency should they happen. So you might not be able to actually allocate everything into invested instrument. So you might need to keep still a huge portion of fixed deposit because your expenses is high. Probably you need to take 6 months of your expenses. So this is what I mean by there's always a constraint over here. So an IPS always have a recommendation, but we say that subject to a certain constraint because of an individual preference of individual needs. So that is what I meant by the recommended portfolio. There's always a constraint for most people. Okay. Right. So this will be the component, one of the first components in an IPS. The second component, and it's quite important in an IPS as well, we do what we call as, everyone is familiar with this, what we call as a risk profiling, right? But for the sake of completeness, a lot of when you invest in PRS, whether you invest in unit trust, you always have this risk profile that you fill in, 1, 2, 1, 2, ABC, right? And most of the time we just as part of the process, the paperwork only lah. It doesn't really mean much, right? But in an IPS, we treat this very seriously. Okay, very seriously. A reason being, if someone feel that they are aggressive investor, but he or she might not be aggressive after going through this test, and we want to pinpoint that, because what an IPS is using, that we are using, is actually a Phenometrica. It's a world-renowned risk tolerant expert lah. So it's a service, right? It's a service, what we call a Phenometrica risk profiling, and they are expert in risk profiling, meaning that we do this risk profiling not for the sake of doing only. Okay, it's really it's really a serious thing because some people might feel aggressive, but after going in, taking all the options available to them, so we might realize that he's actually an average risk profile. Okay, the reason is very simple. Let's say even though you feel yourself is very aggressive, however, if you do not have any savings, FD in your bank account, every month your salary just go in, go out, right? So meaning that you cannot afford to go for aggressive because you do not have enough emergency fund to back you up. So in this case, for example, in this snapshot here, after going through about 10 or so questions, right? The green tick, meaning that the green tick is what we call as a matching risk profile, meaning that statistically, if this really aggressive people for let's say question 2, 3, 5, 6, 7, and 8, so this individual answer this risk profiling correctly, meaning that an aggressive investor will actually answer option 3 for question number 2, 3, 5, 6, and 7, 8. Okay. However, we realize that for an aggressive investor, he should answer question 1, option 4, right? And this one, the red ticks would show that it does not tally with the aggressive risk profile of himself. So in this case, even though he feels himself is aggressive, some will say no. From Fina Metrica, what we call as a risk tolerance, well-renowned risk tolerance test, we say that you are actually not aggressive. You are actually moderate based on your situation and the way you answer some of the question. Statistically speaking, lah. Okay. Okay. I'm going to pause a while if audience have any questions so far.
Yeah, if you have any questions, just post in the chat box and let us know, and we'll get to it. So basically, the risk tolerance profile, is it like Firma Metrica is the like #1 source we use for most independent financial planner, or is there anything else they're using?
This is the one that we use for risk tolerance as well. As for any other options, I'm not too sure of other options. But when, of course, I do think there are. But when we say about for example, when we say about what are the office productivity software that is most common and most widely used and over the world. And first thing people will say, oh, Microsoft Office, right?
Yeah.
So, but of course, there's things like Google Sheets and even Apple have their own productivity software. But I would say that even though it is, I couldn't say it's the top, but this is the most what we call as the industry usage.
Standard or something, right?
The standard Fina Metrica. So you can Google it too. So this is the one that we use to actually spot any discrepancy in what investors think they are versus what a truly, let's say, aggressive investor should answer some of the question. If you reveal to you actually, hey, no, you are actually not aggressive. So and this is based on again the statistics and data. This is one of the components that we can help investors to discover their own more about themselves also.
Okay, good. What's next?
Now, next, again, a component in this IPS is what we call as an efficient frontier. Okay, efficient frontier. Let's say to simplify for the sake of illustration, right? Efficient frontier. This concept is based on a Nobel Prize winning work by what we call as Harry Markowitz. He's a mathematician, and he actually won a Nobel Prize many years ago to solve the puzzle of how to achieve maximum return with the least amount of risk. I think this is what everyone is striving for, right? Maximum return for the least amount of risk.
Yeah.
So he actually have calculate a mathematically correct portfolio that were most effective in balancing the trade-off between risk and reward, or reward means return of various asset class. He called this portfolio efficient and was able to plot them graphically to illustrate a range of possibility for each level of risk or expected reward. Now the graph below show the outcome of his work okay, simplify, okay. It shows the efficient frontier. Okay, let me explain a bit on this. An efficient frontier would fall on the line, directly on the line of this graph, meaning that if you see the blue dot, the connecting lines of the blue dot, that would be what we call as an efficient frontier. So for example, if you see, let's say the last dot over here, right, 25%, they say that for a 25% level of risk, you should expect about 11% or slightly more than probably 10.5% of return annually over a long period of time. So if your portfolio, so that is what we do for clients, right? So like I say, before and after, okay? So if you can see these two triangle over here, when we first engage the clients, we gather all his asset, all his investment, and he show us where he's invested in which fund, which portfolio, what Malaysian equity. Okay, we don't say individual stock we just say Malaysian equity because we are not dealing with individual funds or stock. We are talking about very high level asset allocation, whether it's Malaysia, Asia Pacific, property, whether it's local or global. So in that sense, is when we gather all this data and we construct what we call as a weighted average return of his existing portfolio, you can see there is this triangle over here, the purple one. And they say, oh, your portfolio will have something around 10, let's say, for illustration sake, about slightly more than 10% in terms of risk, then your expected return will be about maybe about 7% like that lah. Okay, so based on this concept, you always want to maximize return for the least amount of risk. Now, after we restructure your portfolio, right, again subject to certain constraint. For example, if you're already invested in a property, the constraint is you cannot sell this property and buy another one straight away, because we tell them it's not efficient, right? Cannot, So, but for very liquid funds, I think, oh, you are very heavy in Malaysian equity. Okay, so you should not be too concentrated on Malaysian equity. You shift it some to global equity. This is something that we can do shifting. Because it's liquid funds, So, and again, back to our question is that when we restructure someone's portfolio, and we always want to restructure in such a way the end result would be something like in the second triangle shown over here. So as you can see, the expected return, the average return will be something of probably around 9%, and it will be something, the risk of course is higher lah. Okay, because if you want to have a higher return, the risk is higher. So the risk would be somewhere probably about 17%. Now, so this is what we want to achieve when we say that we want to restructure an investment portfolio. But this will also help an investor to discover, let's say if when we know all your investment asset and we do what we call as an efficient frontier analysis for you, your portfolio may fall under here, right? Maybe here, just let's say slightly here. So your what we call as your risk will be 10%, right? But your expected return, maybe you hold a lot of FD, will be 4%. So meaning that your current portfolio is not efficient at all because it fell below what we call this efficient frontier line. Frontier line, right? So the further it gets below this line, the least efficient it gets, because your portfolio should fall this line, very close to this line, the efficient frontier, to maximize your return for the same amount of risk. So if your portfolio fall under here, it means that you are taking a lot of risk for very little return. And that is what we mean by not efficient. Okay. So conversely speaking, if your portfolio for some reason fall above this line, that means you are very efficient. You no need to and just keep what you are doing. Although this is rare, but this does happen, let's say so but by theory it should fall on this line, what we call as an efficient frontier. So again, this is a tool, a concept we feel that is very good to educate clients, because it also set an expectation for clients and also let them see in investment it is not all about return. The risk comes with return, or in other words, I think a risk and return comes together.
Okay, nice.
Next one would be, the next one would be what we call as historical return. Because then you ask that, hey, this data historical return, what are the data that comes into constructing this what we call efficient frontier? Of course, these are from our system. These are what we call as different asset class. What are the historical return for the, let's say, past 20 years. Okay, of course, when we do an IPS, we cannot just pluck a number from the sky to say, oh, Malaysian equity return averagely is about 20% for the past 20 years. We cannot, because when we do an IPS for compliance, we must have what we call as a data data that would be very credible data to back up our data, the data that is used to construct an IPS, and this is the data I can share with the audience. Meaning that these are data. Let's say if you put this data, let's say Malaysian equity in which year, right? These data are taken from sources like Morningstar. So Morningstar is a research investment research firm, world renowned. So these are the data that we collect, the system collect to compute the what we call as an IPS. So it's not a figure that we take from the sky. All right. So these are the data.
Okay, looks good.
So
these are the data that is being used to actually come up with all the calculation of the returns and also the risk as well, right?
Yes. Because as an investor or as a client, I always want. I mean, maybe we are of engineer background. We always want to question, hey, this figure how you compute one, right? What are the inputs to that, right? So I mean, we cannot plug a figure from the sky because this is a compliant issue, right? It's not to say you're painting a castle in the air, right? So these are the data backed by sources. One of the sources is, of course, is Morningstar to compute the IPS graphical representation of how different asset class has their different returns over a long period of years. And I think you're approaching the end, but this to answer your first question, right, Casey, is actually to say that managing the expectation of returns, and for anyone managing a portfolio, especially especially true for advisor or especially true also for fund manager, we always wants to set an expectation of return for investor or clients, right? So remember we talked about before restructuring the portfolio, the pie chart, how it looks like, and after that, how the pie chart looks like after we restructure, and taking into account the concept of efficient frontier. This is one of the important components in the IPS as well. Now, how to interpret this? So, how to interpret this is that, okay, if you have what we call as a current portfolio, right? You see the table at the lower section here, current portfolio, referring to your pie chart before restructuring. So, they say that if you have an allocation of such, okay, without doing anything, we can say, historical speaking, your return within 1 year would be about 36.71. And because these are the historical data, remember, these are the data we take from here. Okay, if based on your asset allocation mix. So actual historical return about 36%, and your actual historical average about 7.9 to 10, but just ignore this, right? And we say the expected return percent about 6.71 over a long period of time. But I just want everyone to look at actual historical highest and actual historical lowest. You can see or not, 36.71 and minus 14.75. Meaning that with your current portfolio, we say that, okay, based on historical data, if you only want to see in a one period time frame, maybe your portfolio likely to go up to 36%, shoot up, or it is also likely it will drop 14%. So again, this set expectation for the future. Now, when you lengthen the time to 3 years, when you lengthen to 3 years, averagely every year, annually you would have probably about 16%, and historical lowest, it will be about minus 1.7, we say lah. However, if you lengthen it again to 10 or 20 years, you can see that everything actually normalized, you see, smoothen out. Because they always say that if you invest for a long period of time, and we don't do trading and all that lah, so your portfolio should return positive one way or another. Okay, because markets, when it drops, it always bounce back. So which is why over a long period of years, you can see that everything normalized. Okay, you just see from left to right. Okay, And when we actually say that, okay, this is what we propose for you, if we restructure a portfolio, make it more diversified, and we allocate certain funds in certain asset class, of course, we want to increase the return. You see, if you compare this 10, 20 years over column, so you increase your return about 12.92 compared to 9.79. And of course, the actual historical lowest will actually also bumps up a bit. Not too much, not too much. But this is not the point, the main point that we want to highlight here. The main point we want to highlight here is actually, with this table, we can tell clients to say that, hey, if you have portfolios like this, within 1 year, this is what you expect. Within 3 years, this is what you expect. If it goes more than this, if it goes around, let's say in 3 years, if it goes around 16%, this one is not in 3 years. Every year about 16%. Annually, this all are annual return for the past 3 years. Then you shouldn't be surprised. You see, you shouldn't be surprised because this is expected already. However, we also say that if you say that, okay, you invested in this amount, and we say that if your portfolio drop about 10% within 1 year, you also shouldn't be surprised, because it is expected within 1 year, because it could drop around minus 15% for your current portfolio. So in a sense, you see, when clients come to us and before they invest, we do this IPS for them. It's a pure advisory services. We say that, hey, these are the expectations. If it drop not more than minus 15%, please don't call me. Because this is expected. Because it's only 1 year. We say 1 year, if market like oil and gas, nobody can expect oil and gas counter to actually drop, right? So within 1 year, within 1 year, you cannot really see, you cannot really gauge the performance of the portfolio. Maybe you see it in 3 years. But we set the expectation to say that, hey, you expect this portfolio allocation probably will drop 10% if the market goes haywire this year from historical data of course. So in this sense, we tell you the bad thing first, and you set the expectation right. So this is how we actually do to set client expectation right when it comes to investment return.
Yeah, great. Again, this table is quite sophisticated, because all the return here is like stated on a compounding basis. So it means like but for 20 years we are getting 8.44% highest. That means you will get the high chance of, the highest you might get should be like 8.44 a year per year average, and what you expect is 6.71. So so if you have like investment horizon of 20 years, then it makes sense just to restructure your portfolio and make it the proposed portfolio where you can get like average at 8 point something.
Right. So again, to talk out one last point for this slide, to say that a client come to us and say that, hey, your portfolio you only can expect only about 10%, 8% per year, not very good. I got my friend, he said, the investment they recommend, 1 year 30%. Okay, I said, okay, 1 year 30%, correct. Okay, first we always talk about risk, but second I said, hey, 1 year 30%, actually I'm not surprised, because probably that is a good year for that fund or for that investment instrument, and that is expected. So if you go up, suddenly shoot up by 36% for that year, don't be too happy, because this is also expected. But when it drops for minus 50%, also it's expected, right? So it's very important to set the expectation. So these last two slides is actually okay. That is all about the important components in an investment policy statement, right? The important, what we call top 3 or top 4 components. But most importantly, there's 2 concepts that we actually tell clients in an investment policy statement, IPS, to say that, fear is stronger than greed. Because we know this saying, they say that, be what we say, be greedy, right? When people are fearful, be fearful when people are greedy, right? But
Yeah.
actually, we realized that especially the oil and gas dropped last year, and we realized a lot of investors actually, even though they know the meaning of this phrase, but knowing it is one thing, practicing is another thing, because for the very simple reason is fear is a stronger emotion than greed, because we think that we will be greedy when others are fearful, but because fear is a stronger emotion and it plays a greater role in decision making than logic. So even though you know that at that time you should be greedy when others are fearful, but you just cannot brush away this emotion of fear when it comes to when the market is going against your way lah. But in one way or another, our clients tell us that by having an investment policy statement (IPS), that kind of helps to actually precondition them to prepare for the worst in investment, to prepare in maybe not 100%, but at least maybe 50% or 60%. So this is the concept or the role that the IPS wants to deliver. Okay.
Okay, good. So it's sort of like set the
And
expectation for the full investment horizon, right? Do you have like
yeah,
so is just now the table, is that an example of IPS?
yeah. This is an example of
Okay.
IPS. Again, this is not fixed because you see the numbers over here. It depends on what is your current asset allocation, and the proposed portfolio depends on first is a recommendation, and second is any constraint you have. Okay, constraint meaning that if you are a conservative risk profile, you cannot go for everything equity, so these are very dynamic, but these are the framework. These are the snapshot of one of the IPS that we did lah. These are the components. This is exactly what a client will expect.
Yeah, like normally how much they pay for this kind of analysis to be done?
Actually, it's very affordable. Currently, we only charge about 500. Okay, 500
Okay.
only
For the
for this
investment.
portion,
Okay.
for the investment policy, because it is we only because it is an integral part of financial planning, a financial plan. But we only look at your investment portion. So we don't analyze your cash flow. We don't analyze your risk protection. We don't see whether you can achieve your financial goal or not. So we don't do that. So consider that as a modular portion, one module of a financial plan.
Okay, good.
Uh,
That's why
yep.
that's why you only charge like 500. I know that like a
Yes,
financial
yes,
plan,
yes.
at least it'll be like four figures you have to pay for that, for the whole financial plan, because a lot of work's involved.
Correct.
I know. Okay.
Yes, a lot of work. Yes. That you are right. You are right, Casey. So yeah, uh, this is another point that I want to share, or a financial plan you let you see. Like I said that risk is always personal. When people say there's a risk in stock market, there's a risk in property investing, risk here, risk there. Even you drive also got risk. Nowadays you take a aeroplane also got risk, right? A bit should not be that risky lah. But it's a risk is personal because this digest it, because your risk is investing. It's not that you underperform the market or lose money in the next market downturn. It's nothing of that, right? Risk is actually personal because it is a risk that every one of us would not be able to accumulate, let's say, enough to send our child to college, or our money would not be wouldn't be able to last as long as we wish in retirement. So again, one concept as we go on, we just want to share with kind of financial planning is not about what everyone is doing. It's just about you. Okay, especially when it comes to money, there's always risk, and the risk is always personal. So don't really care about no need to really care about what everyone is doing. If yourself is conservative, so for what you go into stock market, right? Perhaps if you buy a rental property that can generate your consistent income, tenanted, that would be less risk, and because you know that well, So again, I say risk is personal. Okay, risk is personal. And of course, we always believe that the financial plan process is a comprehensive, integrated process. What we talk about today is just one part of a comprehensive financial plan, which is what we call as a investment policy statement. But the concept is the same. What we want to do to help our client is that whatever they are doing, they just want a second or third opinion on how to optimize their portfolio to optimize return for the minimum amount of risk. That is before. After portion would be what we want to understand you and do the analysis and how you can whether your portfolio stay very near at the efficient frontier or whether it's not efficient, and next step would be how to optimize that. So again, the concept is still the same, even though it is only IPS. So of course, a comprehensive financial plan, you could catch or fix issues before they snowball. They can save them precious time. Of course, everyone can DIY, no problem on that. But as you get older, your finances gets more and more complex. So some people just need second or third opinion on whether what they are doing is right or wrong. And it's like taking your own medicine versus going to a doctor to take medicine lah. And of course, it reduces your financial leakage, which could compound over time, and grow and optimize your wealth without listening to external noises lah. This would be what a proper financial plan can provide. So that's it. That is all from me today. I think we are reaching the 1 hour mark. Thank you very much, and I think we are ready to take any question from
thanks,
our audience today if they have.
Thank you, Ching Fu. Ching Fu is representing Ching and Co, chartered accountants firm. I think I should say Ching and Co Wealth Management, remember, right? Because you are heading that department in the financial planning, so I'm a manager with them, and so that's good. So we're opening the floor to any of your question if you want to ask specifically about financial plan or about investment planning that you want to know. Just type in the chat box and we'll get to that. Okay, we got a question here. Is the efficient frontier calculation available online, or must I be your client to have this done?
Okay, efficient client calculation, of course, is available online, meaning that it wouldn't be so straightforward as it is, because even for us, there's a lot of tools that we use to actually come up with that. Of course, when you say about calculation, I am probably assuming you're asking the calculation like when we say about calculus, right? In university or in Form 6, we're talking about calculus. How to do, whether you manually do the calculation and all that. It is available online. Yeah, you can look up for, let's say you just search for efficient frontier and you will come up with a lot of search results. Of course, whether you want to calculate on your own and what are the inputs to use, that is another matter, of course. But the concept and the basic calculations, right? Because it's a Nobel Prize winning concept, so it is available online. You can check it out.
Okay, good. So as a summary, that you can do your own calculation, but the data will be the data that you use. You have to source on your own also. You have to know like which type of data you want to use, and it also depends on what type of assets you are investing in, what is inside your portfolio right now. So okay, good. This is a question by KS. He said it's preferable to sit down with you to go through it, he said. Okay, good. Thank you. And I think your firm like Ching and Co, you also spend a lot of money to actually acquire this system, right?
Yes, thousands per year. Because if you are providing this kind of advisory, I think it's very important when it comes to compliance, right? Compliance meaning that it's same like in any accountant firm, right? When you are audited, when clients or even external auditor come, they say that, hey, you provide these figures, where this figure comes from, how you want to back up this figure. So from it must be credible, and data can be backed up, even though it's a historical data. It's the same like I'm not sure, because I was from what we call as I was working as an engineer in Penang. And when they say about data, they always talk about, okay, how this data comes from, right? Whether the measurement system they're using, whether they have a standard, right? They have a gold standard that they can refer to benchmark it against. So from compliance standpoint, if this question, when we are gonna audited as an advisory firm, if we cannot back up this data, then we'll get this ourselves in trouble.
Okay, awesome. So say thank you. Great. So do we have any other question? Just type in the chat box. If not, we are going to end this session pretty soon. I'll just give me one more minute, and so before I let you go, just want to say Happy Chinese New Year to everybody, and Happy Holiday to the non-Chinese, and for the Chinese, yeah, have fun during Chinese New Year, and don't eat too much. I guess that's what we will do normally. And if you need like a personalized financial planning service, you can always contact CF Lieu directly, cflieu@chenco.com.my. Okay. We have feedback from Kudip. He said is this session is very technical, given from the data is to compute like all the stuff like deviation, everything. But he said thank you very much for your information. And yeah,
thanks
we'll see you all after Chinese New Year. Stay tuned. So I'm just gonna leave this webinar on for a while. If you like want to request for any topics from Lieu, just type in the chat box so that we can get you arranged, because Lieu will be a regular here. He'll be appearing here like for twice, I mean once every 2 months, so you'll be bi-monthly bi-monthly issue. Okay, so yeah,
Okay.
just type in the chat box and let us know what you want to hear from Lieu, because Lieu, he has experience in doing financial planning, so I guess you have a lot of case study you can share with us.
Yeah, sure. Well, yeah, I mean, happy Chinese New Year as well to everyone, to you, Casey. So I think, yeah, that's great. I think everyone is on holiday mode already. So okay, I also half holiday. Okay.
Good, thank you. Bye bye.
Okay. Bye
Bye
bye. Thanks
bye.
everyone.
Bye bye.
Thanks. Bye bye.